So you've owned a rental property for years, maybe even decades. You're sitting on a massive nest egg. You've definitely paid your dues. You've dealt with the tenants, the toilets, the termites, the whole shebang. And now you're finally ready to sell and enjoy your retirement. But what if I told you there's a silent partner in your property, the IRS, and they've got a claim on it that you might not even know exists?
You're probably doing the math in your head right now, planning for a 15, maybe 20% capital gains tax. But for so many landlords, that idea is a dangerous myth. The reality? In a high-tax state like California, the effective tax rate on a huge chunk of your profit could climb as high as 42.1%. Today, we're going to pull back the curtain and find out exactly why.
Look, you did the hard work to build this asset. This is supposed to be what funds your future, your healthcare, your legacy for your kids, but that silent partner has been watching the whole time. And when you go to sell, they're showing up to collect on a tax that catches almost everyone completely by surprise.
Yeah, that 15 to 20% figure. It's what everyone talks about, right? But for rental property owners, it is not the full story. In fact, you know what? It's not even close. The real story involves a totally different tax, with a different and much higher rate that gets applied first. Okay, so let's get into it. Here's our game plan. We're going to expose this hidden tax bomb piece by piece. First, we'll get our heads around this thing called the 25% recapture bomb. Then we'll uncover the incredibly dangerous allowed or allowable trap. After that, we'll actually calculate what your real tax bill could look like, explore the only real escape hatch, and finally talk about how to turn this whole potential liability into a lasting legacy.
All right, let's start with the big one, the depreciation recapture bomb. To really understand it, you have to completely change the way you think about all those depreciation deductions you've been taking over the years. So what in the world is depreciation recapture? Well, it's basically the IRS's rule to recapture or take back the tax benefits you got from depreciating your property. And here's the most important thing to get right now. The profit you made from all that depreciation is not a capital gain. Nope, it gets taxed all by itself at a special federal rate of 25%. Now, here's the best way to think about this. It's a real mindset shift. In the eyes of the IRS, every dollar of depreciation you took wasn't a gift. It was more like an interest-free loan they gave you to help your cash flow. It was a nice benefit, sure, but it wasn't free. And when you sell that property, that loan is due, and they want their money back.
And this lays it out perfectly. You're paying two totally separate taxes. Over here on the left, you've got your normal capital gains tax on how much the property's value went up. We all know about that one. But then, on the right, you've got this recapture tax. It hits every single dollar of depreciation you ever claimed, and it hits it at that higher 25% rate. Your final tax bill is a blend of both of these.
Okay, let's keep building on this, because this next part is where a painful mistake can turn into an absolute financial disaster. It's a trap that's literally written into the tax code, and believe me, it catches so many landlords who just didn't know any better.
You see, the tax code is brutal. It doesn't actually care if you took the depreciation deduction. The rule says your property's basis gets reduced by the depreciation allowed, that's what you claimed, or allowable, that's what you could have claimed. So here's the punchline. Whether you took the deduction or not, the IRS is going to tax you as if you did. And this creates what I call the double penalty. Just think about it. You got zero of the yearly tax savings from that deduction over the years. But now, when you sell, you still get hit with a full 25% recapture tax bill anyway. It's truly the worst of both worlds. Okay, if this is you, if your heart just skipped a beat, there is a fix, but you have to act fast. Do not close the sale. Call your CPA right away and ask them about filing a Form 3115. This form can let you catch up on all those years of missed depreciation, but it absolutely must be done before that sale is final. All right, let's put all the pieces together and see what your real tax bill actually looks like. Because that 25% recapture rate, that's just the start. There are other layers of tax that get stacked right on top of it. So let's stack them up. You start with that 25% recapture tax. Then you add your standard 15 or 20% capital gains tax. On top of that, if you're a higher earner, you get to add the 3.8% net investment income tax. And finally, you throw your state tax on the pile, which in a state like California can be over 13%. You add all that up, and the total can be just staggering. Just look at this example. Say you bought a place for $200,000, and now it's worth $600,000. Simple, right?
You think your gain is $400,000, you're expecting to pay about $60,000 in federal tax. But the reality is, after all those years of depreciation, your taxable gain is way higher. In this case, $550,000. The first chunk of that gets taxed at 25%, the rest at 15%. All of a sudden, your federal tax bill jumps to over $90,000, and that's before we even talk about state taxes. So, is there any way out of this mess? Yes. Thankfully, yes. The tax code gives us one powerful escape hatch, and this isn't some shady loophole. It's a provision that's been part of the law since 1921. It's called a Section 1031 exchange. A 1031 exchange lets you sell your property and then roll all of the money, every penny, into a new, like-kind investment property. When you follow the rules, you get to defer 100% of the capital gains tax and 100% of that nasty depreciation recapture tax. You basically get to kick that tax bomb further down the road. But, and this is a big but, you have to follow the rules, and they are absolutely ironclad. The second you close on your old property, a 180-day clock starts ticking. You have just 45 of those days to formally identify, in writing, your potential new properties, and you have to close on one of them within 180 days total. There are no extensions, no excuses. Now, deferring the tax is an amazing tool, but what if there was a way to potentially make it disappear forever? This is the ultimate strategy. This is how you make sure that nest egg becomes a real legacy for your family instead of a giant tax liability. The magic happens because of one of the most powerful and, frankly, incredible provisions in the entire tax code, the step-up in basis. What this rule says is that when your heirs inherit your property, the cost basis isn't what you paid for it way back when. Instead, the basis steps up to whatever the property's fair market value is on the day you pass away. So here it is, the master plan. You use 1031 exchanges to keep deferring that tax, swapping from one property to the next for the rest of your life. You never write that huge check to the IRS. Then, when your kids or grandkids inherit that final property, the basis steps up to the current market value. And all those decades of deferred capital gains and depreciation recapture, poof, they can vanish, completely and legally wiped off the books. So at the end of the day, you really have to ask yourself this. Is that property you've worked so hard for truly a nest egg that's going to fund your retirement and your family's future? Or is it a ticking tax bomb just waiting to detonate when you sell? The choice and the strategy is up to you.